Well, on that note, let's get in some important opinion coming in from Mohammad El Arian on the possibility of the Fed raising rates, the state of the U.S. economy, and how the U.S.-China trade tensions could end.
Slowdown is overseas more than in the U.S., particularly in Europe, and there are concerns about China. So the main worry is that we get spilled back onto the U.S. economy. So far, the U.S. economy on a standalone basis is fine, but the U.S. economy cannot overcome headwinds from the rest of the world forever. My view from day one, and I've said this and you guys have covered it, is 3 hikes is what I thought they should do this year. They ended up signaling 4 and reiterating 4. So between what they should do and what they end up to do, there's a big difference. It is very hard for the Fed right now to go back to 3 hikes for this year. If they don't, the market is going to say, wow, the economy is much weaker than we anticipated, or the Fed is much more open to political intervention than we thought. So I think the Fed has put itself in a bit of a box, and they're going to have to go through with 4 hikes. But my preference from the beginning of the year was 3, and then see how the global economy evolves, not just the U.S., but the global economy.
Definitely one of the big triggers for the U.S. market is the December meeting of the Federal Reserve. But President Donald Trump has once again said he is not a little bit happy with his appointment of Jerome Powell as the chair of the Federal Reserve. Now, in an interview to the Washington Post, Trump said he thinks the U.S. Central Bank is way off base with what they are doing. Hear out what David Lebowitz of JP Morgan Asset Management and Hereon Timmer of Fidelity Investments are expecting from the central bank in the month of December.
I think what you're seeing is that the Fed is taking a look at the world, and they're looking at the interaction of fiscal policy and the economy and kind of this global dynamic. And they're saying, you know what, growth looks pretty good, but we think growth is going to slow back down next year. Inflation is really not a problem. I mean, even when you look at that wage print of 3.2% from the most recent jobs report, when you factor in productivity, that's consistent with inflation around 2. And so I think what the Fed is saying is, look, we think growth is going to be okay. It doesn't really feel like inflation is going to be a problem. We're getting very close to our estimate of neutral, so perhaps over the next couple of months they'll begin to signal some sort of pause. That's been our view all along, and I think maybe a hike in December, 2 hikes next year brings them to neutral, and then we get a little breath of relief.
The Fed has much more cover now to, not stop its hikes, but to slow them down, and maybe instead of 5, as the dots suggest, maybe go to 3 or 4, and instead of doing 4 over 6 quarters, they do 3 over 8 quarters. And one lesson that we've learned over and over in this rate of change world is that less tightening is the new easing, right? So in 2016, the Fed kept tightening, but it slowed down its track, and that was enough for liquidity conditions to ease up, the dollar to come down, and the markets to reflate. If the Fed does the same thing now, I think that would be a significant lift for the market in 2019.